Welcome to this explainer. Okay, so have you ever looked at the stock market and just felt completely overwhelmed? You know, the endless sea of financial jargon, those flashing red and green numbers, the crazy complex charts. Yeah, you are absolutely not alone. The financial world often feels like it's speaking an entirely different language, right? But today, we're going to strip all of that away. We're going on a clear, scenario-based journey to understand exactly how investing actually works, right from the ground up. By the time we wrap up, these intimidating concepts won't just make sense, they're going to feel like second nature.
All right, so here's our roadmap. 1, the basics of ownership. 2, making your first trade. 3, how you actually earn. 4, tracking the broader market. And finally, number 5, understanding market risks. Let's just dive right in.
Step 1. The basics of ownership.
So, we've got to clear our first major hurdle here. What does it actually mean to own a company? Let's picture a real-world scenario. Imagine, just for a second, that you suddenly own 50% of YouTube's stock. No way, right? But what does that actually entitle you to? Well, it's not just some digital number sitting in an app. If you own half the stock, you literally own half of YouTube. I mean, half the servers, half the intellectual property, half the physical office space, the whole shebang.
And that's because a stock represents actual, tangible ownership in a company. Each individual unit of that stock is what we call a share. So when you buy a share, you're becoming a shareholder. You are buying a fractional piece of a public company. It's basically a business whose ownership is intentionally sliced up into these individual shares, so they can be freely bought, sold, and traded by everyday folks like you and me.
Now, how does a company actually get to that point? Well, it all starts when a private company needs to raise money to grow, what we call capital. To get that capital, they go through an IPO, or initial public offering. This is a massive milestone. It's the exact moment a previously private company becomes publicly traded. And once that IPO happens, that's when everyday investors can finally step in and buy those newly minted shares on a stock exchange.
Which brings us to step 2, making your first trade.
Okay, now that those shares are out there in the public, how do you, as an everyday investor, actually get your hands on them? You might be picturing yourself walking right up to a stock exchange in New York, handing over a stock of cash, and walking out with a fancy paper certificate. But yeah, it doesn't quite work that way anymore. You need a broker. Since you can't just walk onto the trading floor yourself, a broker does the buying and selling for you, usually for a small fee. Today, these brokers are almost entirely digital online platforms. They're essentially your secure, personal gateway to the broader market.
So you go to your broker to make a trade. Right away, you're going to encounter this fascinating tug of war between two key terms, the bid and the ask. The bid is the absolute highest price a buyer is willing to pay for a share. On the flip side, the ask is the lowest price a seller is actually willing to accept to part with it. And the gap between those two numbers, that's called the spread. That spread has to be completely resolved, meaning buyers and sellers have to meet in the middle before your transaction can actually go through. But hold on, before you can even look at the bid and the ask, you have to know exactly what you're looking for, right? That's where the ticker symbol comes in. This is just a unique little abbreviation used to quickly identify publicly traded companies. When you place your order through your broker, you'll punch in this exact abbreviation to make absolutely sure you're buying the correct stock. It's super important for avoiding mix-ups with companies that might have similar sounding names. Moving right along to step 3, how you actually earn. All right, so you've navigated the broker, crossed that bid-ask spread, and boom, you are officially a shareholder. So how do you actually start seeing a return? Well, when a company makes a profit, they basically have a choice to make. They can reinvest all that money back into the business to keep growing, or they can distribute a portion of it directly to the people who own the stock. That distributed portion is what we call a dividend. Now, not every company pays them, but for the ones that do, it is literal cash deposited right into your pocket simply for being a part owner. How great is that? But the absolute crucial point here is what you do with those earnings, because this introduces the absolute magic of compound interest. This is a real game changer. It means you aren't just earning money on your original investment, you are also earning interest on the interest you've already accumulated. If you take those dividends and consistently reinvest them to buy even more shares, you create this massive exponential curve of earnings over long periods of time. It is literally the core engine of long-term wealth building.
And all of this rolls up into one really simple word: yield. Yield is the actual tangible amount of money you have successfully earned from your investment, whether it's through the stock price itself going up in value or from those dividends we just talked about. Your yield represents the real-world success of your financial journey so far.
Step 4, tracking the broader market.
So far, we've been looking pretty closely at individual companies and your personal earnings. But how do we zoom out and measure the health of the entire economy? We do it by using an index. Basically, an index is a method to track the performance of a group of assets all at once. It measures a basket of stocks intended to replicate a specific area of the overall market. The most famous example, and you've definitely heard this one on the news, is the S&P 500. It efficiently tracks the 500 largest US companies simultaneously. It gives you a perfect snapshot of how the overall market is doing, without you having to go and check every single individual business. When we look at that broader market, we generally categorize its mood into two constant terms: bull market and bear market. A bull market means prices are generally rising, and a bear market means prices are falling. Now, what's kind of fascinating is the trivia behind these names. They're actually named directly after each animal's specific attack style. A bull attacks by thrusting its horns upward, which perfectly signals a rising market. A bear, on the other hand, attacks by swiping its heavy paws downward, signaling a falling market. Pretty cool, right? But sometimes a bull market just goes way too far, leading us to our next concept, a bubble. A bubble happens when extreme, unwarranted optimism pushes prices for an asset far, far above its actual real value. It's a situation built entirely on hype. And, well, sooner or later, those sky-high prices become completely unsustainable, and the bubble inevitably pops. Prices fall dramatically until the item is valued at, or sometimes even below, its true rational worth. Which leads us right into step 5, understanding market risks. Look, investing isn't a guaranteed win. We have to face some macroeconomic realities, starting with the absolute basics of supply and demand. This is the core of price volatility. It's the exact reason why a stock moves up and down so quickly. Supply is the quantity of an asset that's actually available to be bought. Demand is the quantity that people actually want to buy. If demand is super high but supply is low, prices rocket upwards. But if supply is high and nobody wants to buy, low demand, prices fall. It is the raw underlying engine behind literally every single market movement. And then there's a much more hidden, systemic risk that affects all of us: inflation. Inflation is a general rise in prices across the entire economy. Just think about your weekly groceries. Inflation means the steady decline of your purchasing power over time. Basically, your money just becomes less valuable. It literally takes more cash tomorrow to buy the exact same carton of eggs you bought today. So, as an investor, your primary goal is to make absolutely sure your investments are growing faster than inflation can eat away at your hard-earned cash. And that brings us to a deeply provocative question. Can anyone truly beat the market? This idea is known as the efficient market hypothesis. It's the theory that share prices instantly reflect all available public information. Now, if that's true, it means there are no hidden gems or secretly undervalued stocks out there, making it completely impossible to beat the market consistently over time. So the question is the market truly that flawlessly efficient, or can a smart, focused learner like you find an edge? It's a fascinating debate, and it really sits at the very heart of the investor's journey. Thank you so much for joining me for this explainer, and keep learning.